Ladies and gentlemen, welcome to another episode of the Cautious Trader here. Today, I wanted to basically go over a little bit of my investment philosophy and what I'm trying to do in the months coming ahead. So, without further ado, let's get into it. Today, I'm actually going to share with you some of the stocks I'm planning to buy and why I'm planning to buy them and what my thoughts are about them. Uh, and this is also a good segue into giving my proper disclaimers as always. Nothing I say is financial advice. This is for education and entertainment purposes only, my opinions, of course, and you should do your own due diligence and not listen to what I say. Unless you want to listen to what I say, in that case, by all means, do, but do so at your own risk. So I want to start off with Apple. Um, I'm always interested in getting more shares of Apple, of course, because I think it's a great company, and I do think it has a lot more room to grow, particularly because uh, of the innovations they bring to the space, especially with their new chips, the M1 chips, and not to mention, of course, their bigger and bigger focus on their services. And that is increasingly becoming a bigger chunk of their revenue. And I do think um, that coupled with their great hardwares is really going to bring in good profits for them moving into the future. Um, Unfortunately, I do think the stock is quite expensive right now, and it did dip below 120, but personally, I like to see it somewhere around the 110 area, preferably the 100 area, which is insane to even mention because that's $400 before they split the stock. And if you think of it like that, right now it's sitting somewhere around the $500 area. So I do think usually near their keynotes, the stock will see a lot of fluctuation, and those fluctuations will, of course, cause the stock to move probably a little bit lower. If it goes into the 115 area, I will probably purchase half of what I'm planning to purchase, and then 110 and 100, I would love to purchase even more of it. Moving on to the next stock I want to bring your attention to, and this is the stock TSMC, the Taiwan Semiconductor Manufacturing. TSMC is of course responsible for producing chips for AMD and also for many other industry leaders such as Apple and Samsung, and even now to some extent Intel, as they offload some of their chip manufacturing to TSMC because they just cannot um, produce the same level of chips with the 5 nanometer technology that TSMC has. And the 5 nanometer process is something that Intel was planning to get into, but of course, given their low R&D uh, focus and investment, it has led them to stagnate. And that's something I really didn't want to see. I was actually investing in Intel back when it was $40. Of course, the uh, price of the stock has risen since, but I sold it some time ago because I just didn't want to be invested in Intel. I do think they're falling behind. Their market share is being gobbled up on one side by AMD. On the other side, they're going to lose customers such as Apple and Microsoft as they move away and start producing their own chips and architecting their own chips. And of course, who's going to be making them and manufacturing them? It's going to be TSMC. So this is another stock I'm really interested in seeing. If of course it has seen a massive increase in price uh, since the pandemic levels, and with the current uh, shortage in silicon around the world, uh, I do think it's bound to rise even higher. However, we are seeing a beginning of a head and shoulder pattern here, and if we do see that head and shoulder pattern go on and be completed, this could actually fall much lower. Um, I'm not sure if it will happen or when it will happen. Head and shoulder patterns are something that are quite unreliable actually, but if it does happen, we could have it go as low as the $100 or $115 range and come to test this moving average, the 50-day moving average that I've got here shown. Stocks in general do tend to come down and test their 50-day moving averages at one point or another. So this is just a matter of keeping an eye on it and seeing when it's going to get to that point. Next, the stock I want to bring your attention to is Jpmorgan Chase. This is a stock that has performed exceptionally well since pandemic levels. It was actually $78 back in March of 2020, and now it's risen all the way to $150. They had a brief dip into the 130 area, but again they have risen since. And a lot of this comes from the fact that JP Morgan is moving aggressively into the fintech space and trying to um, compete with these large companies that have arisen from the innovation in the financial technology sector, such as the Square, such as PayPal. I do think they have a lot of cash on hand and they can compete. It's a matter of just um, who has the bigger capital and the bigger investment into the area that can win it. And uh, with a large institution such as JP Morgan, they can easily have a lot of their customers uh, be converted into these new products that they are selling or they're bringing to market, such as the um, such as the payment methods that they're offering now to businesses. And I will bring this story about JP Morgan specifically and how they're moving into that space, maybe in a later episode. But for today, JP Morgan, it is quite high. I'd like to purchase more of it. Probably if it comes back into the 130 area or even 140 area, that would be a good opportunity to purchase some more. I think the 140 area is quite possible and within reach, just so it can test this previous level of resistance and turn it into support. If it does dip below that, I would still like to purchase more, especially near the 50-day moving average. Let's go to the next chart. This one is Canadian National Railways. Canadian National Railways, they are generally a great company and they've seen a lot of growth, and regardless of what's happening with the economy, their services are always in need, and it's just a good company I'm trying to add to my portfolio, given that it's also in Canadian dollars, and I would be using my Wealthsimple account to add this to my portfolio because it would be commission free. I would have liked to bought this at the $100 region, but at that time I just didn't have the funds in my portfolio to buy this. Regardless, I will plan on getting it if it does go lower at all. And even if it doesn't, I would nibble at it a little bit in the recent future. Another company we're looking at today is mRNA Moderna. Of course, Moderna, I was in it at, it's a funny story, at $68, and I actually went even lower. It went all the way down to $55, and it went there twice. Of course, it's now at 150, almost triple in price, but it has seen a sharp decline. I think it will go to 128, maybe even lower than that, around the $100 region. It is a very volatile stock, so I would expect to see it move in that area. And if it does, and when it does, I would be looking to pick up some more of it. I exited out of it at $100, and of course, no one ever goes broke by taking a profit, but suffice to say, it is a little disappointing to see that uh, it has risen this much and I lost on these gains. Nonetheless, it's something to keep an eye on. Now, in terms of consumer spending, I'm looking at Walmart and Costco specifically. These two have seen quite a bit of a decline due to, well, in the case of Walmart, negative earnings, and Costco, we'll look at it in just a bit. I don't have it here, I have to add it. But Walmart and Costco, uh, both of these are sort of like the anti-Amazons of consumer spending, and I think that as the economy starts opening it back up, and as unfortunately a lot of these small businesses have gone under, companies such as Walmart and Costco, they will pick up more and more market share. And this is obviously devastating, but it's also something we should take into account when we're looking at investing in companies like this. On the other hand, you might be asking, why not also invest in Amazon? Personally, I have a big gripe with Amazon. I do think uh, it has a lot of problems in terms of treating its workers, and just don't want to be supporting their business model. In terms of Walmart, it has seen a large decline, and the RSI is in the oversold territory. And we can see every time the RSI heads to the oversold territory, we see a large retracement back to the upside with Walmart. So I'm planning to play this uh, stock coming up soon. Next one is Spotify. I also had Spotify around the $230 level. I'm really quite saddened that I didn't purchase more of it at the time, but generally with Spotify, I like Spotify. I I think that it's a great company and personal user of it. And despite all the competitors in the space with Apple Music and Amazon Music and all of that, I think Spotify has got one of the best interfaces and most importantly, one of the most uh, widest demographic of user bases. And I think Spotify is something to keep adding to my portfolio. Probably I will hold off on adding it. It has dipped below the EMA ribbon, and I have to see if it can break above it. If it doesn't, I will wait until it reaches the 50-day moving average and probably around $285 to $300 level. Let's go to the next one. Alibaba is another one I'm keeping my eye on. Recently, it has gone through a little bit of a turmoil. First, there was that investigation that they had to deal with, and I purchased a little bit of Alibaba when it dipped low into the 200 territory, 210s. It went up again. It has come down and broken under the 50-day moving average. I do think it will go lower, probably again to the 220s, before really seeing a retracement, um, and it's probably going to go oversold before it can recover. But I think Alibaba is a major player in the consumer spending space, especially in Asia. So having it in my portfolio is probably a right call. Then we have Starbucks, and Starbucks has been something I've been hesitant to take up and put in my portfolio, but um, just noticing how, like, every day, uh, how much people spend money on their Starbucks cups. It's, to me, obviously it's kind of ridiculous, but it's something to take notice of, and I think adding Spotify to my portfolio and having a portion of it will be beneficial, because ultimately it's uh, it's a company that's essentially got people hooked on it. So having it as part of my portfolio, it would be nice. Probably adding it around the $93 level. It's the previous resistance slash support level. I think 93 to 95 level. If it comes to that point, I will look at picking it up again. Then we have Nvidia. With Nvidia, with recent news of what they're planning to do with their mining cards, and how they're um, going to add enormously to the level of e-waste produced. I will bring an article to you about that as well, maybe in the future episode. But if you just want a quick information on it, there was a LTD video done, Linus Tech Tips LTT video, Linus Tech Tip video done on it recently. I recommend you checking it out if you want more info on that. But Nvidia probably will test its 50-day moving average. Again, as you see with these companies, they tend to come back and test the moving average. I think it will test it around the $500 level. Uh, if it does come to that level, maybe I will be looking at adding it to a portfolio. But to be honest with you, I'm not that interested in it to begin with. And it's just something that, to look out for if you're interested in picking up Nvidia. Then we got Microsoft here. Microsoft, I had it at the 180 level and the 200 level. I really wanted to add some more. I just didn't get a chance to. Um, and another reason why I created this channel is to basically keep myself up to date with these different companies. It's easy to not pay attention to them. Of course, that's why I do my stock picking separate to my general investment. My general investments usually are in mutual funds that are actively managed, and, and other ETFs. But I like picking stocks just as a hobby, and I've created this channel to really keep me invested in this process. So I think Microsoft, if it does head back lower, probably in the 215 area, I'll pick it up. If it does go any lower, I'll pick up more of it. I think it's, of course, a great company, as is like Apple, and it's just a matter of getting it at the right price. Hopefully, it's gonna uh, break through this support area, and if it does and it heads lower, that's where I'll be picking it. Here I have an ETF for you, Zntk. It is a SPDR series trust from New York Stock Exchange Technology ETF. And I've had this for a long time in my portfolio. It's performed very well. Uh, this is something I'm also looking to pick up some more of if it heads lower, and hopefully it does. Probably in the 140 area or even the 130 area. If it comes to test the moving average, I'll pick up some more of it. But here, this is where it gets interesting. And recently, if you've been keeping track in the Canadian housing market, there has been an absolute explosion of activity. Housing prices are going through the roof, multiple offers on every property, and that's why I was recently looking at ETFs that invest in the Canadian real estate market. These are not particularly REITs, all of them, some of them are. And of course, they pay very good dividend, 4 to 5%. But also they will see a growth, and I think they're usually a little bit more lagging with respect to the actual housing market. So investing in them, I'm looking at uh, dipping my toe into them a little bit more because of course, as someone who doesn't have hundreds of thousands of dollars just sitting around in cash, um, we're really losing our capacity to go into that market and to invest in that market. And, and because the housing market is a leverage asset, it's a great form of investment to make great returns. But for someone who doesn't have those huge funds laying around and can grab a mortgage easily, then it becomes an inhibitory factor. Regardless, this is one REIT. It's a Canadian uh, real estate investment trust. This is from iShares. This is another one. I haven't done much research into these yet, and but I'm planning to look at them specifically. Maybe I'll bring a video to you about them. This is from Vanguard, and this one is from Brookfield Property Partners. And this one has seen probably the biggest rise. But I will look at these specifically. Now, as for some renewables, uh, this is one I've had for a long time. TransAlta Renewables, I've had this probably around the 11 to $12 range, and it has performed very well so far. Uh, it has had a bit of a dip, and I do think it will go lower, probably to the 19 or $18 area to test this moving average. If it does, and when it does, I am looking to pick more of this up. It also pays a dividend, I think close to 3%, which is quite nice as well. Let's go to the next one. This is Energix and renewable energy. This is similarly performed very well, uh, but has had a bit of a significant dip. I think it's going to test the $22 area, and if it does, before going back up, if and when it does, uh, I will pick up more of this again through my Simple account, just because it is a commission-free app. Then we have a ETF, a clean energy ETF, or like a renewable energy ETF. Um, this is the iShares Trust Global Clean Energy ETF. This one again performed beautifully. Let's see since March how many percent. Since March of last year, close to 222%. Uh, it is going lower. A lot of these clean energy companies have been seeing a bit of a dip. That's okay. That just gives us an opportunity to nibble at them a little bit more and get them at a discounted price I think around the $21, $22 level, I'm looking to purchase it if it comes to that level. And if it doesn't and it starts going back up, I'll purchase some more. Then we have TAN. This is a solar company, solar energy ETF. It's the Invesco exchange traded solar ETF. This one has also seen a bit of a dip. It will probably head to the 77 to $80 range before heading back up, and that's where I'm looking to purchase some of this specific. Then we have Disney. Disney is something I've missed on, mostly unfortunately due to the fact that Wealthsimple doesn't offer it, which is really unfortunate. With Disney, I'm really looking to grab some of it. If it does start to head back down, there are a couple gaps here created, and I'm not sure if it ever will fill these gaps in its price. But if it does turn around maybe to the 165 area or even the $150 range, 155, I would be looking to add this and add a lot of it to my portfolio, and I will probably do that through TD Direct Investing because of course Wealthsimple doesn't offer. And then most importantly, I think we got the ARK investment portfolios. Now I do have a few mutual funds that are primarily focused on computer technology and science and tech, and those have performed quite well, but not as well as the ARK ETFs. And what I was thinking was that probably in the next month or so, I will liquidate my positions in those mutual funds and start adding them to the ARK ETFs, just because they have the same overall goals in terms of what they're offering. And as I pick up these ARK ETFs, hopefully, and as the ARK ETFs see a bit of a dip, maybe I can get them at a better price. I do believe their outlook is quite bright, but right now, again, this ARK ETF is also showing a little bit of a head and shoulders pattern. And if it does, and when it does, I think it will head back to the 115, maybe even 110 area to test that moving average that's coming up. So all the ARK ETFs, I'm looking at picking them up one by one. So the last one was, let me just see, this one is the ARK Innovation. This one is ARK Genomic Revolution. And this one is the ARK Next Generation Internet ETF. And there is, I think, one more ARK. Yeah, the ARKQ. This is Autonomous Technology and Robotics. So all of the ARKs, I'm planning to purchase them, especially now that they're seeing a bit of a dip. Hopefully they dip a little bit lower by the time I do try and get into them. I do think they have a long way down to go to get to this moving average and test the moving average, and hopefully they will, as they have in the future, regularly touch the moving average. But once they do, I'll look at taking some more positions into it. But the biggest stock that I've been saving, and this is for the last one we'll talk about tonight, is Costco. And Costco has seen a significant dip into the negative category. Not negative, but it has seen a significant dip, and it's massively oversold. It has even gone below the 50-day moving average. I do think it's due for a major pullback to the upside. I'm looking to purchase Costco and add a lot of it to the portfolio. And just by even whenever I go to Costco, and it's not a lot, but whenever I do end up there, the amount of traffic that this corporation can generate in its stores is always mind-boggling to me. And I really don't know how they do it, but I think that their ability to do it is akin to Amazon's ability to drive so much sales through their online website. And it's not like it's the stores or the warehouses are particularly uh, like high tech or uh, futuristic or anything. It's just that it has a very simple model of providing customers what they need when they need it, just how Amazon does it, but again, it's not virtual. It's things that are tangible and people can go to a store and pick it up and really feel it. And that's why I'm probably going to add Costco to my list. As you can notice, this whole process is uh, not very like it's quite feelings based. I do acknowledge this, and I don't recommend to pick stocks like actually for retirement or long-term investment just by going off of feelings or you have for the companies. I do this primarily as a hobby mostly. I do most of my investing through mutual funds, but I do think that it's good to catch up on the news of stocks and just for fun pick a few. So far, it's my positions have done quite well, but again, in a bull market, everyone is a winner. So I am aware of that, and I do acknowledge the risks associated with picking stocks. Um, but I'm not planning to do major activity through this. So yeah, with that said, that has been it. Again, look forward to this tutorial that I'm bringing on Wealthsimple, and probably after that I'll bring one on TD Direct Investing and why I've chosen to open accounts in TD Direct Investing, and probably will be doing most of my stock trading there if it's in US dollar, and renegade all the Canadian dollar stocks back to Wealthsimple, and I'll discuss all about that in a future episode. If you have any questions, concerns, or comments, leave them below, and like and share the video. I really appreciate it, and subscribe to see that Wealthsimple video. That has been it. Thank you for listening.